The most read article I've ever put on my website is how does exotic car financing work? And I've gotten a lot of requests to talk about that here, so let's do that today. And I'll do my best to answer as many questions as I can in the body of the video, but at the same time, let's treat this as sort of an AMA. So if you come up with any questions you want answers to throughout the day, just post them in the comments and I'll do my best to answer. It's worth noting that people finance exotic cars for a lot of different reasons. Certainly some are avoiding tying up the cash because their other investments are performing so well or the market's doing so well that it doesn't make sense to put it all into some potentially depreciating assets. If you're looking at a $100,000 car that you think is going to go up, if you put 100 grand in and it sells for 120,000, that's a 20% profit. If you put in 10 grand and finance the rest, leveraging it on your credit, that's a 200% profit. So that makes a lot of sense. But certainly, and this is what people are critical of, lots of people are financing exotic cars because they simply can't afford to do anything else. They can't write the check. I've been in that boat. I've helped people in that boat. That's sometimes a contentious idea, and let's avoid that debate for today and just talk about what banks look for. There are 5 things banks consider when you apply for a car loan. The first is your credit score. The second is your experience in similar loan products. The third is the structure that you're requesting for your loan. The fourth is loan to value. And the fifth is your ability to repay it. So let's go through each of those, at least in the context of exotic cars, and talk about what it really takes to finance your dream car. So the first is your credit score. Most banks will consider top tier credit either a 720 or a 740. Anything above that is really unpredictable and doesn't matter. If it starts to get much below that, we're going to have to overcome it by weighting towards another one of these factors. The next is your comparable car credit. So banks usually don't want to be the first to extend any type of credit to you. They want to see that you've paid something similar for a good amount of time. And so generally, they don't want to go beyond your previous high car credit by more than about 50%. Some banks might do 100%, but you don't go from a $20,000 car loan to a $200,000 car loan. Generally, you'd want to work your way up through 3 or 4 cars over a year or 2. The next is the structure. You'll see a lot of different programs, leases, extended term financing, and all of them are interesting, all of them are possible, and I've done most of them myself. The most traditional car loans are going to be 48, 60, or 72 months. So 4, 5, or 6 years. And those are generally going to carry a payment of anywhere from $15 to $20 per thousand financed per month. So if you finance 100 grand, it's going to be $1,500 to $2 grand a month. You'll see some banks that'll do extended term financing, particularly on newer cars, maybe 84 or even 96 months, particularly if they're captive lenders. Banks like BMW Financial Services, Audi Financial, Porsche Financial, so they'll loan you money for longer because they have a vested interest in these manufacturers selling you cars. I've also written a lot about extended term financing through companies like Woodside Credit. And they're an awesome bank that does ultra long-term loans, 10 or 12 years, so up to 144 months. And in those situations, your payment generally becomes about 1% of the car's value. So you can imagine that a $1,000 payment for a $100,000 car makes things pretty affordable. You'll see leases as well. Those will be for variable terms, different lengths, require different cap cost, and the interest rate there will be disguised as a money factor. And these leasing companies exist for 2 reasons. One, generally the payments are going to be a little bit lower, and sometimes they can be a little bit more lenient with approvals in the periphery of other variables that we're considering here, but also because in certain states, taxes are only charged on monthly payments for leases rather than all up front. So if you actually only intend to own a car for a year or 2, you could save, a lot of money by just paying the taxes on the lease payments each month rather than at the upfront purchase price. And you'll hear the words direct and indirect lending, particularly when it comes to exotic cars. Direct lending means you're applying for the loan yourself. You're talking to the bank, you're giving them your information. Indirect lending means you go to the dealership, you fill out their credit application, and they apply for credit on your behalf. That can be really useful because they can sort of serve as a buffer to help you with certain answers to certain questions, and they know what banks are looking for. Indirect lending is a profit center for your dealership. So when you look at the interest rates, and interest rates on exotic car loans can be anything from 1% to 10% for even well-qualified buyers, depending on the term of what you're looking at. So the bank is going to provide the dealership with what's called a buy rate, and the dealership can mark up the interest rate to make money on you during a car deal. And so if they buy the loan at 5%, they could sell it to you at 7%, and that 2% is going to pay them a reserve profit. So it's worth noting that the dealership may not be giving you the best rate that you've qualified for, and you can negotiate through that and ask them questions about it throughout the process. The longer term loans are generally going to be 4.9 and higher. Some of the traditional loans, particularly through a captive financier, can be 2%. 0% financing is not a real thing. No banks are loaning money at literally zero profit. What's happening in those circumstances is the exact opposite of a reserve profit in the event of indirect lending. Either the dealer or the manufacturer is giving up some of their profit on the front end of a car deal in order to buy down your interest rate to that 0%. So it still relies on you getting a great interest rate, maybe 1, 2, 3%, and then they're having to put in their profit to make you feel like you're not paying any interest. But that interest rate is also going to depend on our next variable, loan to value. And that's one of probably the most discussed things in the nature of a car deal, because it really comes down to what you have to put down. So banks will have a fixed percentage that they want to loan relative to what they deem the value of a car to be. And that's going to be based on some sort of a book value. In some cases, it might be Kelley Blue Book, Black Book, NADA guides, a recent wholesale transaction. And then they're going to want you to reduce their investment or their collateralization of the asset based on a down payment or a cap cost reduction in the event of a lease. And so to be perfect, I'd say that most banks want 20% relative to their book value. And a down payment serves both you and the bank to improve the loan to value and eliminate the risk or minimize the risks of depreciation. So in the aggregate, cars depreciate about 1% a month, but we all know that it's perceived that cars lose 10 or 20% of their value the day you drive them off the lot. And while that's common knowledge, most people don't understand why that is. We see the MSRP and we're aware there's something called invoice, and that's what we think dealers pay manufacturers for cars. But in reality, there's bonuses, there's incentives, there's performance numbers. There's a lot of contingent money that dealers can get. And so you'll hear numbers called triple net, and that's what a dealer really ends up owning a car for. They're always going to pay a little bit more for a car that they buy brand new that's never been titled, has a full warranty. And so that immediate depreciation is really the dealership profit going away. And depending on the term you've arranged with the bank for your car, they may notice that you're not going to be paying it down at enough of a pace to overcome the depreciation, and that introduces the risk of becoming upside down, meaning you owe more for your car than it could actually be sold for. And now we got to talk about whether or not you can afford to pay for it. And banks use income calculations in a little bit of a different way than we might be familiar with. If you apply for a mortgage, depending on the product, you're going to be looking at a 40 to 45% debt to income ratio. And that means that all your monthly obligations or the payments you have need to be less than 45% of your gross monthly income. With cars, it's a little bit different. They want you to prove your income, usually with a tax return or a pay stub. They'll want to see a total annual income that's greater by some margin than the total sum of all your car payments, particularly in exotic cars. So if you make $100,000, a $100,000 car would be just about as much as you could ever finance. And they'd probably like it to be more like 80. Now let's say you can't prove your income, or you don't have enough of a down payment, or you don't have any experience financing something like that. It's always possible for you to make up ground through another area. So if you make $1 million a year and you want to finance a $100,000 car, that's usually pretty easy to do, even if you've never done it before. If you put 50% down and you can't prove your income, that kind of makes up for it. They think, well, if you came up with 50% down, at the very least, the loan to value is excellent, and I'm probably not going to have to repo it because he still has a high credit score, even though there's not a lot of substance behind it. Let's say you don't have a high credit score. You can do things like make all the lease payments up front. You'll see things called one-pay leases. So let's say that you're doing a 36-month lease on a $100,000 car and the lease payment is $1,000 a month. If you give them 40 grand, in a lot of cases, even if your credit score is 500, you still might be able to drive home in a brand new 911. And that's where we see some of the really attractive leases falling, is about 1% a month. And that generally means that the manufacturer, whoever is writing the lease, has a lot of confidence in the long-term value of the car. Something else to consider is the age of the vehicle. New cars are always eligible for the lowest interest rates. That might be contrary to some logic because they're the more likely to depreciate, but banks are always more comfortable with them. Older cars get harder to finance. You go ahead and try to finance a 10-year-old exotic, there's not that many banks that are going to want to do it. You may end up having to go with one of these longer term arrangements like Woodside Credit, and they're going to want more money down just because they have a little bit less confidence in whatever the car is at that point. And they also know that, the car is out of warranty. You could have a catastrophic maintenance event that could render you less capable of making your payments. So exotic car financing can be a very empowering thing. There's lots of ways to do it. There's lots of programs that can make it make sense. And your payment could be anywhere from 1% to 2% of its value per month. This can allow you to buy some amazing cars a lot sooner than you might have been able to if you just had to write a check for it. And it can make it a lot easier if you want to make money on cars. But I'm all for whatever it takes for you to buy the car of your dreams and enjoy it in the best ways you can. And I'm here to answer any questions you have about the idea.